Hi, I'm Chase Wilsey, and I'm with Wilsey Asset Management. Today, let's talk U.S. postage. Now, while this may not sound like a very exciting subject, it is pretty amazing when you look at it. The price of the U.S. stamp is set to fall for the first time in 97 years. The last time this happened, the year was 1919, and Woodrow Wilson was President of the United States. The price of the stamp is set to fall from 49 cents to 47 cents. Now, why is this happening? Back in 2013, Congress passed a bill for the USPS, United States Postal Service, to charge a 4.3% surcharge. Why were they enabling them to do this? Because they lost a lot of profit during the Great Recession. The act is set to expire on April 10th once USPS recovers $4.6 billion in revenue from the surcharge. The last time the price of the stamp fell, it fell from 3 cents to 2 cents. Man, I would love to be paying 2 cents per stamp right now. The USPS CEO says this will be a disaster for the United States Postal Service. And tomorrow I'll be taking a look at the financials for USPS and see why it will be a disaster for them. Next, let's take a look at the ISM Non-Mfg Index. Now, why is this an important index to follow? The US is a consumption-driven, service-based economy. So, we pay for CPAs, we pay for financial advisors, we pay for plumbers, we pay for handymen. All of those are service-based jobs and help drive our economy. Taking a look at the numbers here, the index came in at 53.4 versus the consensus estimate of 53.1. Now, what does this mean? When the ISM Non-Mfg Index is above 50, that means we saw an expansion. When it's below 50, that means we saw a contraction. So 53.4 is a good number to see here. Taking a look at some of the components of the ISM, new orders were up 55.5. Great to see. That means we saw a lot more new orders over this period. However, employment was 49.7, so a slight contraction there. Curious to see how that affects the employment report tomorrow. Also, with the high amount of new orders, we should see employment improve over time as they will need to hire more people to fulfill those new orders. Taking a look at the company of the day, let's take a look at Fitbit. Symbol here is FIT. The current price for Fitbit is $12.30. 52-week range, $11.91. 52-week high is $51.90. I really like the company Fitbit. I use their product, Fit. I like to stay in shape. I got a lot of questions from my friends about Fitbit when the price was $50, $40, $30 a share, and I said, great product, just overvalued. Now with it at $12.30, is it a buy? Let's take a look at some of the financials for Fitbit. Current ratio of 2.67, great to see. That means they have nearly 3 times amount of current assets over current liabilities. They're a very liquid company. Also, big number here, debt to equity of 0%. Company has no debt on its balance sheet. I love to see that. Profit margin of 9%, well above the industry average of 3%. So the company is making good money. Very important to take a look there. We get a target price on Fitbit of $19.14. The reason for this is we take the 2017 December estimates for earnings per share on a GAAP basis of $1.13. And we apply our 16.5 multiple, which is the 40-year average of the forward PE, to arrive at a target price. With this target price, we get an estimated return of 56%. So Fitbit appears to be a fit company. Thank you for joining me today. Make sure you go to our website now, smartinvesting2000.com, to sign up for our upcoming workshop, How You Should Invest in 2016. We'll be hosting this workshop at National University in Rancho Bernardo from 10 a.m. to 12 p.m. on March 19th. And there we'll be analyzing a stock that could potentially be a buy in our portfolio. That company is Qualcomm. They're locally based, very exciting. We will also be reviewing stock fundamental analysis and why it's successful, explaining when to buy and sell a stock, and also going over the 5 common mistakes the average investor makes. We hope to see you there.